All right, folks, we're going to break into that conversation that we were having with Bob Cusack for just a moment, just to bring you an update on a developing story that's happening at this hour. The Federal Reserve announced today they are raising interest rates. The rate is going up by 1/4%, and this is the third hike in the past 15 months.
Now, the last increase happened to be in 2006. And if you save, invest, use credit, or if you want to buy a home or a car, we've got a lot of news on that front. Correspondent for TheStreet TV, Scott Gamm, joins us now to tell us what this all means. Scott, I guess the big question many people have is how will the rate hike affect average Americans?
Oh, well, look, I mean, the rate hike will mean higher borrowing costs on credit cards, car loans, mortgages, but we're not talking by a huge amount. Of course, the Fed announced a 25 basis point increase today. This is the third rate increase since the 2008 recession. Interest rates were dropped to near zero back in 2008 in an effort to revive the economy. Here we are, 8 years later, and rates are still very low. So what you're going to see over the next, couple of days is the banks start to increase their prime rate, which is the rate that the most credit-worthy customers will use. So again, we're talking about a very small increase here. And for, mortgage owners here, if you're looking to buy a house, maybe this rate increase adds about $40 a month to your payment. So again, not to worry for homeowners out there.
Scott, does this benefit you more if you are a saver or investor? And is this bad news for Americans who carry a balance on their credit cards?
Well, look, if you do carry a balance on your credit card, yes, you're going to see, that interest rate creep a little bit higher. But again, it's not going to be that much on that front, although credit cards usually react the fastest to a rate increase from the Fed. So the first, product to see a rate increase is going to be on credit cards versus mortgages. In terms of savers, look, the Federal Reserve has done a lot to try to revive the economy over the past 8 years. But one group of people they have hurt is savers. I mean, look at the savings rate you're getting on your, savings account, the interest rates you're getting on a money market account, they're nothing. So you can't really earn money and build your nest egg if you're sitting around with a money market or a savings account. So yes, this will help that. But again, it's such a small increase that interest rates on savings accounts are still going to be very low. In terms of whether or not this will be good for the stock market, that's a little bit more of a complicated question, right? For years, investors were worried that a rate increase would hurt the stock market, right? Because investors love this stimulus, this support from the Federal Reserve. But now, the other school of thought is that, well, hey, if the Fed is raising interest rates, that means that the economy can stand on its own 2 feet. And the Fed rate hike today was a real endorsement of the economy. And that in and of itself is widely viewed to be good for stocks.
So you've walked us through the stock market. You've told us not to worry about home mortgages. But ultimately, as you talk about the economy, what does this mean for America's economy to have a rate hike like this?
Well, like I just mentioned, it means that the economy is strong enough to withstand less support from the Federal Reserve. The Fed talks about normalizing policy here, and normal policy is anything but 0% interest rates, which is something we've had for years now. And if we rewind back to December of 2015, that was when the Fed first raised interest rates since December of 2008. It was a big deal, and at that time the Fed said, hey, in 2016 we're going to raise interest rates 4 times. And that, of course, didn't happen. 1 year later, in December of 2016, the Fed announced its second rate hike. And then at that time, they said, hey, we're going to raise interest rates 3 times in 2017. And everyone kind of, didn't really believe the Fed. Yeah, okay, you're going to raise rates 3 times this year. I don't believe it. And then over the past, 3 months since the start of the year, the stock market has rallied largely on expectations of tax cuts and infrastructure spending under President Donald Trump. Of course, we hit 20,000 in the Dow. That was a very important milestone. And then about a month ago, the Fed started signaling, hey, the economic data is good. We had a great jobs report last Friday showing 235,000 jobs were created in February. And now the Fed was saying, look, wait a minute, maybe we can raise rates in March, and maybe we will stick to that 3 rate hike forecast for 2017 that they issued back in December.
All right, correspondent for TheStreet TV, Scott Gamm, thank you for your time, man.
Thank you so much.